So yesterday we discussed the issue number one and two, which is from CIT, and that I think, if I'm not mistaken, the administrative review process. And so if we go to issue number three, Apex Construct Private Limited, the group construction arm completed on comprehensive refurbishment on the Grand Hotel in Nuerelia. The contract was signed on 50th August 2023. Fixed sum of 80 million excluding taxes. At that time, VAT rate is 15%. The work was certified because the work was completed on 30th December 2023. The final invoice raised on 20th Jan 2024. The client, because from 1st January 2024 onwards, you know that VAT rate is increased by 3%. Now the VAT rate is become 18%, not just 15%. The client has returned the invoice refusing to pay 18% VAT. The site that 23 contract date is basis for their refusal. During the internal audit, you discovered that SSCL was not charged yet on this invoice because this is not a manufacturing company. This is a construction service. Therefore, 100% turnover as per the act is liable. Otherwise, if it is a manufacturing, 85% based on the liable turnover is subject to SSCL. So, not charge on this invoice. The finance manager justified by this by stating construction is a manufacturing process. No, it's a service. So we are not providing any movable product. We fall under the manufacturing base liable on 85%. But since we have huge input credit from cement and steel purchase, because VAT input you cannot offset from the SSCL input, our net liability is zero. That is wrong. So therefore, you are asking to 10 marks with reference issue to assess the indirect tax compliance risk associated with the hotel innovation invoice, advising the validity of the client refusal and accuracy, the internal SSCL treatment of effects, practice collecting SSCL from clients. If you not registered for VAT, you can't charge. You same way, if you not registered for SSCL, you also cannot charge. So this therefore. So if we go to the suggested solution, the time of supply is the supply of goods shall be deemed to have taken place earlier occurrence of the following. An invoice was issued. In this case, the invoice was issued on uh, this date, uh, 20th Jan 2024. So now we did a payment of goods were received. No, payment is not clear. A payment of goods for due to supplier or such supply, because the works are completed on 30th December 2023. Delivery of goods effected, the invoice issued with 10 days. The 10 days threshold was violated because this date more than 10 days there. Therefore, the earliest occurrence date is was completed and due date is 30th December is that day. Therefore, the applicable VAT rate is 15%. So if you go to the suggested solution, VAT rate determination under the section 4 subsection 3 of the VAT Act, the time of supply is earliest occurrence of invoice or payment. So, however, early performance, invoice or payment. However, section 4.4 allows the invoice date to become time of supply only if the invoice issued within 10 days of performance. So 30th December work certified, invoice days is this date, lapse of 10 days because 21 days passed, therefore time of supply is 30th December. The applicable tax rate is 15% of the VAT, not 18%. You must immediately issue a credit note to cancel the 18% invoice and reissue a new tax invoice which stipulate on 15% or reduce VAT by 3%. Because the SSCL liability statutory finance manager classification is void or the invalid under section 2 subsection 3. So SSCL Act number 25 of 2022, any person who carries on business providing service or any description is liable for levy. The definition of manufacture is specifically making to article movable. The construction is immovable because the building can't move, right? So does not fit. Therefore, it is categorized under the service. There, if the service is there, 100% the turnover is liable. If it is a manufacturing, 85% turnover is liable because based on the liable turnover, which are found in the second schedule of the SSCL Act. Correction by applying 85% base, understate the liability. Company must apply the 100% based on the full invoice, need to charge 2.5% from the customers. FM arguments, the financial management manager argument is offsetting the input credit is misleading or the fundamentally misunderstanding. Unlike that, SSCL is a cascading turnover tax. What is mean by cascading? Cascading in the sense. So, a cascading is a gross receipt tax applied to the total value of the goods or service at every stage of production and distribution without any deduction or credit for taxes paid earlier. Because this is a you cannot offset like VAT, you know that output VAT minus you can set off the input VAT and you need to remit the balance tax payable, VAT payable. But in unlike the SSC VAT, you cannot set off any SSCL paid in advance. This is that's why this called as a cascading turnover tax that contains no provision for claiming input tax credit, deducting SSCL paid in upfront basis. So SSCL paid on company raw material is a sunk cost that must be priced to the profit margin because that is you cannot recover, irrecoverable. Therefore, in order to mitigate that loss, you have to charge it from the client by keeping appropriate margin level. Okay. So that liability 80 million into 100% base liable multiplied by 2.5% SSCL rate. So, FM instruct to issue a supplementary debit note of 2 million to client. Failure to collect this will result in indirect charge of the project net margin because you finally supposed to pay this. So that is your need to be your answer. If we go to the with reference to issue 4, Inland Revenue Department contains that profit from the disposal of Green Valley land constitute business profit rather than a capital gain. Evaluate the validity of this assertion but apply relevant legal tests established in case law to determine method of realization has altered the character of the asset from capital to trading stock. Assess the possible direct and indirect tax liability and net tax payable on this transaction, assuming the IRD classification is upheld. Okay. So if we go to the issue number 4, Agro Apex Agro is a group subsidiary dedicated for export agriculture an effort to diversify in an effort to diversify its crop portfolio. The company engaged significant land transaction in hill country. Udaratawala in April 2020, the company purchased 10-acre state-owned Green Valley in Candy. 80 million. The acquisition was funded through short-term bank facility, let's say bank some loan, something short-term, not loan, audio something. Board minutes 2023 confirmed that the land was purchased exclusive for the cultivation, export, cultivate vanilla and organic spices. Following the purchase, the company invested in soil testing, test and commenced initial land preparation. However, severe and unforeseen adverse weather patterns of late 23 caused unexpected soil erosion, rendering the lawn unsuitable for sensitive spice cultivation. Consequently, the board passed a resolution to abandon the agriculture project and recover the capital investment. That means 80 million rather than selling the acre block at a single unit to another plant. The company decided to maximize the disposal value between January, Apex Argo, cleared the land entirely, subdivided 4 individual residential allotment, split, okay, constructed internal roads and concrete drains, engage real estate brokers to market plots aggressively to individual buyers. All 40 sold by this date for 240. 240 minus 80 means 160 gain is there after deducting the land cost 80 million, the project net profit of 160. Because this is not a land business company. This is a gain on realization of the investment stock. Uh, Tax dispute the company portion. The finance manager has recorded this profit as a capital gain. Yes, investment. This is a yes, correct. Share simply realization of the capital asset after original business purpose. The IRD challenged this. Assessor argues that this company action, specifically the organized subdivision infrastructure development, making demonstrate that effectively convert the asset into stock in trade, engage in the commercial business. Because based on that, IRD assessment is likely valid because you have taken some kind of initiatives to sell this asset. We must apply the principle from Ram Iswara versus Commissioner General of India regarding method of realization. Even if with the initial intent was investment agriculture, subsequent actions can convert the assets into trading stock. Apex Argo engage in aggressive modification, subdividing 10 acre 40 to maximize their actions, constitute badges of trade modification on organization overriding the initial agriculture intent. The transaction is nature of trade. So therefore, assessment of tax. Note the scenario confirms that improvement 60, value of improvement 160. This figure represents the economic value added severe. Liable turnover because this is service 160 into 2.5. Corporate income, that is SSCL. CIT 160, business profit. Deduct the SSCL assessable income is 156 and CIT 156 into 30%. 46.8. 46.80%. Blood plus for 50.80%.